Welcome, G-Traders. You are watching a recap of the Asian session on July 5 with me, Kate Stichina. The Asian stock market incurred moderate losses on Wednesday. The Chinese economy has been showing signs of a patchy recovery, and this dampened investors' confidence, so they again took a cautious approach. As a result, the US dollar gained some ground despite the thin market on the national holiday in the United States. US financial markets were shut on the occasion of Independence Day. Nevertheless, futures on the S&P 500 looked a 0.1% downtick. The Nasdaq futures slipped by 0.2%, and this week the minutes of the Fed's latest policy meeting and the US government employment data are on investors' radars. The Asian benchmark indexes fell by 5% on the average today. Some sectors looked a steeper fall by more than 1%. For instance, Hong Kong stocks dropped by 1.2%. Poor data on the manufacturing and services sectors in China worsened fears about a slowdown in the second largest global economy. Soft foreign demand moderated business activity in the Chinese service sector in June, and thus the correspondent PMI fell to the lowest rate in the last 5 months. In turn, the subdued service sector took its toll on the recovery. The services PMI by CAIXIN and the S&P Global sank to 53.9 in June from a 57.1 in May, and it's the lowest reading since January. The official services PMI released last week also indicated a muted business activity due to weak demand for services. China's economy expanded faster than expected in the first quarter, but it lost momentum in the April-June quarter amid strong deflation, high unemployment among the young, and soft foreign demand. Economists have detected the evidence of a second wave of an economic crisis in the second half of 2023, and China is due to report its GDP data for the second quarter in mid-July. For the time being, China's economy has stalled in space of growth. However, it could pick up steam rapidly later on. Chinese stocks are now trading at a bit discount. Interestingly, the time is right to enter the market now. Besides, signs of some improvement in the relations between the United States and China could be viewed as a good omen. U.S. Treasury Secretary Janet Yellen is going to visit Beijing this week, and her first visit to China will be devoted to reassessment of the relations between the two largest global economies. American officials are betting on efficient discussions during Yellen's visit scheduled for July 6-9. On a Monday, Beijing unexpectedly imposed restrictions on the exports of a certain gallium and germanium compounds applied in the semiconductors. Moreover, Beijing passed a counter-espionage law. These moves are considered a threat to American companies. Shares of some China's cheaper compound manufacturing companies soared because of potential disruptions in supplies, and the news encouraged a rally of metal market quotes. The US dollar index is trading higher ahead of a publication of the Fed's minutes later today. The index settled above 103 points in the Asian trade, and this week the instrument has got stuck in a range. Traders unwilling to open large bets, waiting for clues to further policy moves of the Federal Reserve. Currently, the markets are betting on another rate hike by 25 basis points later this month. Fed Chairman Jerome Powell said that the central bank would go ahead with the further rate increases because it takes time to bring inflation down to the target 2%. Today, traders will get to know US factory orders for May that could influence market sentiment. However, the highlight of the week is certainly the US nonfarm payrolls. The US economy is expected to create 225,000 jobs in June, much fewer than 339,000 jobs in the previous months. Average early earnings could have grown by 0.3% from a month ago. The Japanese yen is showing signs of resilience in early July, but it still stays not far away from historic lows. Today, the dollar-yen pair traded at 144.70 in the Asian session. The yen is on a track to be defined as the weakest currency of the last months and this year. Traders used to buy the yen as a low-cost way of accumulation funds for investments in high-yielding assets abroad. Credit rate investors commonly preferred assets of developing economies, especially in the last decade. However, sharp increases in the borrowing costs in advanced countries made credit rate investments popular for other currencies. At the present, monetary authorities in Japan and China are conducting the policy of devaluation of their currencies in a parallel, but they are pursued the goal in different ways. Japan's policymakers stepped up the rhetoric against the yen's depreciation last week, so the Bank of Japan will venture into forex interventions if the dollar-yen pair surpasses 145, heading for 150 amid high volatility. Meanwhile, the currency pair climbed to the resistance at 145. And hence the price is likely to consolidate at this level. The overall outlook for the yen is bearish. The yen is expected to pass 145.17 and the low of December 2022. The next resistance is projected at 146.60. The upward target is seen at 148.5. Australia also provided its PMIs today. The services PMI sank to 50.3 in June from a 52.1 in May. Analysts had predicted a decline to 50.7. The AUD-USD pair traded slightly lower. The economic calendar for Australia is empty, so the dynamic depends on the technical factors and the US dollar. The AUD-USD pair has recouped most of its June losses, and the outlook for the Aussie is bullish. For a start, the Australian dollar could test resistance at 0.6715. If it's overcome, the next resistance could be at 0.6745. A breakout of this level could signal a further uptrend with an upward target of a 0.6995. However, if the instrument fails to surpass resistance at 0.6715 and declines, traders will monitor the level of 0.6495. If broken, it will signal a lower drop. Traders are keeping close tabs on the developments in China, and today China's former Commerce Vice Minister warned that Beijing's measures to control the export of cheap materials are only the beginning and could be strengthening if necessary. His statements come amid ongoing technology disputes between China and the United States. At the same time, China has additional means of sanctions and measures to counter new trade restrictions. The statements highlight the importance of the high-tech sector in the current global trade disputes and may indicate that China is ready to move more actively protect its interests in this area, and this could escalate trade tensions and affect the global economic landscape, as many countries rely heavily on the imports of China's technology and the components. The New Zealand dollar strengthened to 0.6195 against its American counterpart at the highest level in 2 months, and the Kiwi has been growing for 4 days in a row. It happens amid expectations that interest rates will remain higher for a longer time on the back of the central bank's efforts to fight against inflation. The Reserve Bank of New Zealand has raised interest rates by 525 basis points since October 2021 to 5.5%. So it's one of the most hawkish regulators in the world, and the nearest policy meeting will be held next week. Nevertheless, the bullish momentum of the Kiwi is capped by a slowdown in China's economy, the Kiwi trade partner of New Zealand. The NZD USD pair could try to test resistance at about 0.6205, and the next move could be a decline to 0.6105. If the instrument rallies and breaks 0.6245, the bearish scenario will be cancelled. And in this case, the currency pair could extend its growth with a target at 0.6435. Make profits with the InstaForex. Your feedback is appropriated. Stay tuned.